This is just my reason for my impact journey, which these are my 4 kids. I have a 4-year-old and 2-year-old triplets. And so they are a big reason what I do professionally, and certainly why I do what I do with my money. And so you'll hear that thread throughout this presentation, but the top right corner is all of them in one giant box, which was because we all got COVID 2 weeks ago, and we were home for 17 days by ourselves. So it's been an interesting start to the new year. So I'm just going to start. Let's see if I can advance this. There we go. Just a little bit of an overview of my path. So, kind of just the time and process that I've gone through in this work. It goes back, when I was putting this together, I realized it goes back about a decade. But I started studying and kind of discovered the world of impact investing when I was in business school. I was lucky enough to study under Kathy Clark at Duke's Fuqua School of Business. And if you don't know Kathy, she's an amazing resource in the space. And so that was when I first learned about this world and started meeting folks in the field. And when I purchased my first community investment note, which is Calvert's flagship product. I then did a couple of years in traditional private sector. I was a consultant at McKinsey for a few years, and then started working at Calvert. And so really started to get much more deep into this world of values aligned investing and impact investing. About a year after I joined Calvert, I realized that I was kind of out speaking about this, but hadn't actually looked at my own portfolio to see whether I was walking the walk. And so I started looking at my portfolio alongside my financial advisor, who happens also to be my mother, and looking at how to align my full portfolio with my values based on a set of goals, and which I'll go over in a second. And then, as Janine mentioned, I wrote my first blog about kind of the process in 2016. Started making angel investments in 2017-ish. This is also when my first son was born. And then the triplets were born in 2019. In 2020, I did kind of an update to my blog. I just looked back at the date. It was March 5th. So it was like right before COVID hit. I did an update to my blog, and then all hell broke loose. And then the last couple of years just been continuing to keep an eye on the introduction of new products and different ways that I could continue to advance my goals. And if anybody's having a baby and wants one of these future impact investor onesies, just let me know. They've got Calvert's logo on the back of them. So I think the most important part of this is really to start with what your goals are, and be really clear about that with you and anybody else who's involved in your financial decisions. So your advisor, your partner, your family. And so just trying to put those goals out in a very clear way. My number one goal is to use my financial assets and really every asset at my disposal to support a world that I want my kids to grow up in. And so that is my kind of number one driving concern. 2 is to generate income and value appreciation that supports both my near-term expenses and my long-term savings goals. And that's primarily college and retirement. But wanting to be clear that that is my second goal and not my first, and that I believe pretty strongly that a couple 100 basis points is not worth a burning planet. And so I look at my portfolio not really from a kind of profit maximization lens, but really a kind of stakeholder approach and how to create both reasonable and expected financial returns, as well as values alignment. I personally like to diversify as much as possible, as much as kind of feasible outside of the stock market. Stock market just kind of scares me, even though my mom's a financial advisor. And I have my ulterior motive in all of this is to use my personal experience to educate my mom so that she could do this with her other clients who have much more in the way of investable assets than I do. So that's a kind of summary of my goals. When I first set out to do this, I was a recovering management consultant. I look at everything in frameworks. I wanted to kind of understand and think about frameworks through which I could organize my portfolio, understanding that putting all of my assets in like direct measurable impact was not really feasible from both a liquidity perspective, return perspective, and a risk perspective. And so what I tried to do was, before a lot of the industry frameworks were available, this was back in 2016, I tried to just put together what I called my values box, akin to the Morningstar kind of style box, to try to look at the different kinds of impact products that were available on the market and organize my portfolio in those various buckets to look at kind of impact diversification. And so that was everything from, kind of the approach, how direct the impact was, and then the measurability of that and the kind of intention behind that impact. Since then, there have been new industry frameworks that have evolved. And so I've tried to align with those in an attempt not to recreate any wheels. And so in my second blog, I looked at basically BlackRock's framework around this, as well as the Impact Management Project, kind of two industry frameworks that are out there that were pretty aligned to look at kind of the range of sustainable and impact investment categories against the different asset classes that are out there. And so because, like it or not, kind of our financial organization, our financial assets and portfolios are largely managed through an asset class lens. I tried to look at that and say, okay, how do I look at each asset class and what products are available within them on this spectrum of kind of how direct or indirect the impact is and the approach to achieving that impact. And so this is meant to make a little bit sense of the kind of alphabet soup that's in the industry. SRI, ESG, impact, sustainable, responsible investing, all the lingo, and really looks at what is just screened, what is actually taking data points into consideration to drive greater benefits to a broader set of stakeholders, and then what is directly contributing to global challenges with measurable solutions. And this is kind of at the time my asset class breakdown against that framework. And so what has that led to in terms of asset allocation? So right now, I think of my kind of investable assets in kind of two big buckets. Those that are in my portfolio. So this is like what shows up on my my brokerage account. And then what I've done outside of my portfolio. So things that I've done more direct private activities, like angel investments or different platforms that kind of show up outside of my brokerage platform. I try to manage about a 90-10 split. So about 90% of my money is in my quote unquote core portfolio, about 10% is outside of it. And then that's kind of my way to diversify a bit outside of the stock market. And then within my portfolio, I probably have a relatively conservative asset allocation for my kind of target retirement. But right now I have, you can see it's about 80-20 equity to debt or equity to fixed income in the portfolio. And again, that's partially because I'm just terrified of the market. And so what I'm going to do now, and I'm going to try to do this pretty quickly, is just try to walk through the different asset classes and some of the pros and cons and options and how I tried to go from where I was to greater values alignment. So we'll start with cash. This one should be the easiest. For me, it was the hardest. And so a few years ago, I think in 2017 or 18, I I made my husband and I both close our Bank of America accounts and open our checking and savings accounts with City First Bank, which is our local CDFI bank. Which is a community development financial institution. They are required to invest at least 60% of their money in the community, in low-income communities in the DC area. They actually just merged with Broadway Bank out in LA, and so they're now the largest Black-owned bank in the country. This was really important. This is the work I do day in and day out. It's really important for me to align my checking accounts to support local community development. I will say this has been one of the more painful processes to align my money with my values, mostly in just technology and customer service. And so, just the unfortunate reality of our financial system is that big banks are getting bigger, smaller banks are getting, smaller or not growing as fast. And so they just don't have the same amount of resources to invest in technology and customer service. And so this one has been a little bit more challenging, but I think there are options where you don't have to give on customer service and technology to align values, and I think more of them are popping up. So happy to talk separately about that if it's helpful. Public equities. So this is basically my non-mutual fund stocks. I maintain a very small, what I call my activist portfolio, and so this is how I award good corporate behavior when I see it, if I'm really excited about a decision that was made or want to support a certain company. So when CVS stopped selling cigarettes and kind of transferred to CVS Health and focused more on health and wellness, I bought some CVS stock. When Starbucks decided to pay for college for all its baristas and create kind of better benefits, and now that they're allowing some unionization of some of their stores, but back when they offered educational benefits, I bought some of their stock. I have Hannon Armstrong, which is a 100% sustainable clean energy company that recently that went public a couple of years ago. So I maintain a couple of single stock positions just to support companies that I want to own, that I think are good companies doing good things. And then I have a couple of indices, which are, there's like an SDG, kind of iShares index, things like that, that just give me a little bit more kind of direct exposure. On the mutual fund side, this is obviously typically where majority of people's money sits, and was where the majority of my money sits. And I think this is where some of kind of a framework or approach is helpful, because you could spend all day, every day researching mutual funds. And so it can be a real time suck. My general approach to these funds is to put more weight on the manager. So really try to find mutual fund companies where sustainability and responsibility is built into the core of the company, and where I kind of believe the manager is taking the right approach in terms of ESG incorporation. So that's typically kind of where I start. And then I look at the individual strategies of the manager and find ones where I'm aligned with the kind of stocks that they're picking. And so the easiest way to do that is you can quickly, by just Googling their symbol, you can find the top 10 exposures. So I've listed the example of Brown Advisory Sustainable Growth Fund here. Their top 10 exposures, I kind of look through them and make sure there's nothing in there that I don't agree with or I don't want to see. So I try to avoid, oil and gas companies, obviously things like private prisons, and me personally, I don't like owning like big pharma. There's like a few industries that I just try to stay away from. And so you can look at their top 10 holdings, get a sense of where the majority of the portfolio is, and then decide whether that's a manager that you agree with or that is aligned with your general values. And then secondly, I kind of look for what I call kind of more pure strategies. So this is a great example. The New Alternatives Fund is a mutual fund that is solely invested in renewable energy companies across, as you see, solar, wind, hydro, conservation. That's the only thing the manager does. They've been doing it since like 1982. and have had a good track record of performance. And so this is one that I was excited to buy because I didn't have to worry about, maybe them buying something at some point that I wasn't aligned with. This takes time to go through. And so, I think having, if you work with an advisor, having your, asking them for their top strategies and then going through, 10 or 20 fund options before selecting a handful, I think is helpful. The thing that folks often worry about is, okay, the managers can switch positions anytime, so I'm not going to check on a daily basis what my fund is holding. But that's why you typically go with more of these kind of pure play or managers that I believe are really trying to do the right thing in terms of stock selection, so I don't have to monitor them all that often. And so this is certainly a process to go through. And from a performance perspective, over the last few years, these funds have all performed extremely well for a variety of kind of both micro and macroeconomic reasons, but they've all performed well. And then I'll just say one thing: I tend to go with actively managed strategies. I like that someone is paying attention and really looking at different companies and making those decisions. There are also, obviously you pay for that in fees, but there are also some indices, but I just haven't been thrilled with the kind of quality of the indices, most indices. And so have largely gone with actively managed strategies to date. That's starting to change. I'm looking at Ascena and the awesome work they're doing, and there's some others that are starting to create ETF strategies, but so far I've done mostly active. Oops. And then fixed income. This one is my kind of day-to-day work, and so I know this space a little bit better. But obviously I hold our community investment note, which is something that can show up in a portfolio you can get through your brokerage fund. I've looked at a variety of green bonds. So when there's a new issuance of a green bond that looks interesting, my mom will usually send it to me and see if it's something that I want to own. So an example, Apple did one a few years ago where they basically issued a corporate bond to make energy efficiency and renewable energy investments across their whole global footprint, their kind of buildings. And so I bought that. And then on the municipal bond side, I try to look at pretty closely at use of proceeds and what the bond proceeds are going towards, and make sure that's something that I agree with or I'm supportive of. So if it's going to build a school or a series of schools versus building a prison. So you can typically take a look at some use of proceeds and get some advice on that. And then lastly is kind of privates and alternatives, looking at diversifying outside of the market. This includes some kind of platforms. So I've done some just testing around on platforms like StreetShares, which is direct small business lending to veteran-owned businesses. I have some money on the Fundrise platform, which is kind of a direct real estate investing platform. I have not been thrilled by their kind of the impact lens on Fundrise's work, but I'm just fascinated by what they're doing in this space. And so I like to have a little bit of money with them. And then I have made a handful, I think 8 at this point, in direct angel investments, small investments into companies that are companies that I really like, believe in, and want to support from both a financial and impact perspective. Just a quick note on a couple other things. One is kind of other money. So a lot of people have, majority of their savings in things like their company 401k plans, IRAs, or their kids' 529 plans, kids or grandkids' 529 plans. Usually you don't have a lot of options and choice in these. And so I try to take a approach. One is selecting whatever kind of ESG or sustainable strategies are available. And then also really trying to push the sponsors to include more options. So we went through a process recently where we updated our company 401k options, that we had a much broader range of strategies that we could buy into for our company 401ks. I've been pretty disappointed by DC's 529 plan options. So at some point I will advocate for more options there, but I think this is where you can kind of share your voice and push for just inclusion of more and better options to align your values. And then last thing I'll just say is advisors. For anybody that's working with an advisor, as I mentioned in the beginning, I think it's really important to be clear on your goals, what you're seeking, and to speak with them at kind of a values and strategy level first before diving into specifics. I have found over and over again from my very brilliant group of girlfriends, but that those that don't work in finance, that they often get intimidated by kind of just the lingo, the verbiage, the terms that financial advisors use, and they don't understand it. And so they just kind of defer to their advisor without much pushback. And I think try to always make sure folks understand, none of this is rocket science, and make sure that you have an advisor that's supportive, that's helping you with your research, and that's helping you kind of along this journey. And if they're not, then you can change. There are a lot of advisors out there. So I think with that, I'm going to wrap up so I can have plenty of time to answer questions, and really appreciate everybody's time and excited to dive into Q&A.